let's not assume that the difficulty in expenditure will persist next year. So the thing is, there is incentive for state governments, bureaucrats as well as politicians, to spend, right? They do want to spend. It's just that they've not been able to spend. So, and it is because of the lockdown, because files cannot be taken out of office, people can't do work from home, and all of those constraints. So, as the state and central governments have a relatively normal year. See, one of the challenges for FY22 was that you entered the year and you were slammed with a lockdown, right? And in the government, in particular, I mean, it happens in large organizations anyway, is that if that first 2-3 months of planning was destroyed, then spending the rest of the year doesn't happen. And so the hope would be that in FY23, this cash can be spent. Though I think there's too much cash to be relying on that hope, but that's my personal opinion. And I think that it is quite, and I would say it is quite likely that 6 months later. So one thing quite likely is that, as I said earlier, as the state governments present their budgets, that 3.6 will go to 4.2 or something, right? That revised estimate for FY22 is higher. And because the center has said you can have space, so then next year's number will also be 3.5, 3.6, right? But maybe by August, September, when they're deciding on second half borrowing targets, I think the likelihood of the government bringing it down substantially is very high.
Okay. Two last questions, Neelkanth. From a sort of monetary policy, fiscal policy perspective, will this level of fiscal deficit, given the reprioritization, be seen as inflationary?
Actually, no. See, all of this is, well, it is in theory aggregate demand, but in many ways, this is still supply.
Yeah.
Right? So you're building more roads, you're building more railway lines, building more airports and all of that. And you're easing compliance burden for customs, you're easing, and a lot of, like even financing for road projects, like, that surety bonds versus bank guarantees and all that. So I don't see this as an inflationary thing. But coming to the implications of monetary policy, that's very interesting. That so-called accommodation, I think, ended in September, right? So if you in an environment where there is so much overnight liquidity, the reverse repo is your anchor rate, not the repo rate. And the reverse repo has gone from 3.35 to 4 effectively. I mean, in theory, it is still 3.35, but in practice, so this is equivalent to at least a 25 basis point hike, because the normal window used to be 25 basis points. So the repo is now at 4.25 effectively, right? And the 10-year bond yield is, of course, 40-50 basis points, now 55 basis points higher than it was pre-COVID. So a lot of the monetary tightening has already happened. So that so-called accommodation is only in theory. Now, the challenge, I think, is what will the RBI do in terms of bond purchases? Because clearly, with the bond index inclusion decision not coming through in the budget, doesn't mean it will not happen. It may happen, may not happen, but that decision is an administrative decision, can be taken at any time. It doesn't necessarily have to happen in the budget. But if that doesn't happen, then who buys? So some decision has to be taken, right? Because I think as a percentage of financial saving in the economy, household financial saving, and as a percentage of incremental deposits, these numbers are not that high. It's just that because so there is on the face of it, 8 lakh crores has become 15 lakh crores of gross borrowing, or 6 lakh crores has become 12 lakh crores of net borrowing. So on the face of it, these numbers are substantially higher. But if you see the increase in household financial savings, if you see the increase in incremental deposit growth, these percentages are not that extreme. It's not that that percentage has doubled. So we need to find ways of tightening or slowing down the pace of tightening, because this is like tightening prematurely, even in anticipation of growth. That keeps me slightly comfortable, because that means, like somewhat like China, we actually have created monetary and fiscal space, right? So the counter-cyclical narrative in China now is that the world was giving a stimulus and China was actually withdrawing fiscal monetary stimulus last year, and that gives them space to stimulate this year. In many ways, we seem to have arrived at the same place, that we have a lot of fiscal space which we can seed if we can't spend, and on the monetary side as well, I think we've tightened too much.
So you're saying that markets, etc., have already built in rate increases, which may happen this year, and that's an assumption.
2.9% term premium. What else do you need?
No,
you've been tweeting about it. I know we are on the same page. That's why I'm very merrily harping on this. But I totally agree with you. I think this is maybe what is normal in that chart moves like this. So what is normal is jiski jitni shraddha, right? I mean, so you can decide whether 100 basis points is normal or 150 basis points, but 290 basis points is not normal.
It's not normal.
Yeah. So I think we have already tightened too much.
Okay. Last question, Neelkanth, from an equity market perspective. So what do the equity markets take away from the budget and as they set up for a new financial year? Segments?
Yeah, so equities are more long-term thinking. I wish bond markets were long-term thinking, meaning that I know I've given up that hope on that, but and not because the bond market participants are not forward-thinking, but market as a whole somehow doesn't seem to be pricing in positive surprises on tax to GDP, on government intent, inability to spend. I mean, all of those things are water off a duck's back, right? But look at a higher borrowing number. Oh, yeah, yield badhao, right? So that. But
I should get one of your bond market friends in here. That would make for a good discussion.
Yeah. But the equity markets, not because I'm an equity strategist and therefore I'm more fond of it, but theoretically they're supposed to discount longer term growth, right? And this growth focus of the government, that we will want to focus on longer term growth, sustainable growth, is, I think, positive, and which I think that's why the markets have been responding positively to that. And the fact that there are, of course, no short-term measures, negative surprises on the tax side, I think all of those things have been helpful. But I think that if we don't address this discrepancy, that the government is, because of its own discomfort with projecting to the future, that how much money we will have which we can spend next year, it has kind of been conservative in carving out a space for itself. But when it seeds that space, if it doesn't seed that space, that it creates a problem, right? So you're paying the cost of higher bond yields, but the benefit of government spending is not coming through. And that's actually a cost to the economy. So at some point, that cost has to be withdrawn, which I think will be important for sustained growth.